Alrighty. Hi, everyone. Thank you for joining our webinar today. Today, we will be discussing the money questions everyone has, but few people ask. The presentation will go for about 30 to 45 minutes, and we will be discussing all sorts of different topics today. If you have any questions during the presentation, we won't be doing any Q&As during the actual presentation, but feel free to schedule a meeting with us after the presentation, and we'd love to get those questions answered for you. We also have a retirement readiness event in person in the La Crosse, Wisconsin area coming up, so be sure to be on the lookout for emails and invites on that. But we will kick it off in today's presentation, and let's kick it off. So here are your TrustPoint and Emerge 360 presenters. So Brett and myself are from the Emerge 360 division, and Jennifer Gander is from the Wealth Management Department. So we will be your presenters for today and go through a variety of different financial topics. So first, an overview of who TrustPoint and Emerge 360 is. You are all probably somewhat familiar with some of our services. I know we have people that are joining the call today who are Emerge 360 clients, so anyone $50,000 to $1 million in assets with us. We also have some wealth management clients who are attending today, anyone with $1 million plus with us. And we also have a lot of 401k participants attending the call today. So if you are any one of those clients, or if you just found us online, thank you for joining the call today, and we're happy that you're here. TrustPoint and Emerge 360 are headquartered in La Crosse, Wisconsin, but we also have branches in Minneapolis and Eau Claire and have clients all over the country. We have been around for over 100 years, so we are a pretty well-established company and are able to provide you with a lot of different resources because of that. So here is an overview of some of the services that we offer in a little bit more depth. So I mentioned that a lot of you either know of who we are through 401ks or through individual services, but if you like what you see and like these types of presentations and the services that you receive, please don't keep us a secret. Share it with your friends, your family, or anyone else that you think could benefit from learning a little bit more about finance. So here is our agenda for today. We'll be answering a large variety of different questions on different financial topics, and we'll be switching off who's presenting, so you won't have to hear from me the whole time. But I am going to kick it off with question number 1. So how much is the average person saving? So the average person saving, this is based off of a Vanguard study that was done in 2025. The average 401k participant is saving about 7.6% of their income on average. So what does that actually mean for you? How much should you be saving, and is the average enough? So you should be saving between 10 and 15% of your income for retirement or in retirement structured accounts. So that's between you and your employer. That 7.6% was just what the employee average is. So if the employer is contributing above and beyond that, and you can get to that 10 to 15%, that's great. But if you are not receiving employer contributions, be sure to start wherever you can and slowly increase your contributions to get between that 10 and 15% saved for retirement. If you're a little bit late to the game, maybe you need to be saving a little bit more than this percentage. And if you're looking to retire early, maybe you need to save a little bit more than this percentage, but ultimately this is a good range to decide on if you're on the right track and if you're saving the right amount for retirement. So question number 2, how much does the average person have saved for retirement, and is it enough? Again, this is from that same Vanguard study, and the average defined contribution plan balance in 2025 was just under $170,000. So you can see that those average plan balances have slightly gone up over time. But again, is that enough? And you'll also take into consideration too that all of the different types of people that are contributing to these retirement plans are different ages. So how does that skew with the data? And we've pulled a graph in on that as well. So you can see that the older people get, the more that they save for retirement, which is great to see. But again, is that average plan balance at age 65 of just over $300,000, is that enough? So finance is very personal and everyone's situation is different. So that's something to keep in mind. If you ever have a chance to go through some sort of financial planning, whether it's with us or with somebody else, I'd recommend going through that process at some point. If you do have questions on that, feel free to schedule a meeting with us after the call today, because it can pinpoint a little bit more specifically how much you should have saved and when you can retire and things like that. But nonetheless, this is a great chart to kind of gauge that as well. So the way this chart works is you look at where you're closest to in age on that blue line, and you look up and you should have that times your salary saved for retirement. So if you're age 30, you should have 1 times your salary saved for retirement. And when you get to retirement, and in retirement, we like to see you have about 8 to 10 times your salary saved for retirement. And again, different factors can come into play here, but this is a good guideline nonetheless. And then lastly, when you are saving for retirement, what are those different types of savings vehicles that you can use to save for retirement? So we'll start on the right-hand side of the screen here, pre-tax and Roth. Those can come in many different forms. We can have pre-tax 401ks and Roth 401ks, or we can have traditional IRAs and Roth IRAs and other types of employer accounts as well. But ultimately, pre-tax, the way it works, you're putting money into the 401k plan now. You're not paying any taxes now, but you're paying taxes when you take a distribution in retirement. Roth is going to be the opposite. So you're paying taxes when you put the funds into the 401k plan or the IRA. But then when you get to retirement, you've already paid those taxes, so that entire bucket of money is yours to take out. And then brokerage accounts or after-tax accounts, those individual joint and trust accounts, those are good to be saving for retirement in. Maybe when you get a little bit further or closer to retirement, sometimes it's helpful to build up this bucket of money if you are looking to retire early. Maybe you can't pull funds from your 401ks, your IRAs until you're age 59 and a half. So maybe you need to build up these after-tax funds to be able to use those funds to bridge that gap for those first couple of years of retirement. So if you're having questions on where you should save or what you should save, again, feel free to reach out to us. Happy to have those conversations with you. But now I'm going to kick it off over to Jennifer Gander.
Right. Thank you, Paige. Like Paige said, my name is Jennifer Gander. I work in our wealth management department at TrustPoint. The first question that I am going to answer is everyone's favorite topic, Medicare. So I'll cover how does Medicare work and how does my income affect pricing. So Medicare is a very complicated topic, so this will be a very high-level overview of the different parts of Medicare and what those are for, and also how your income can affect the premiums that you pay. So we will not go into any deductibles or any out-of-pocket costs that you'll pay. So there are 4 parts to Medicare. The first part, Part A, is hospital insurance. So if you have paid payroll tax, so that's Social Security and Medicare that's being deducted from your paycheck, if you have been paying that for more than 10 years, the premiums are free for Part A. It covers hospital care, skilled nursing facilities, hospice, home health care. The only way you can usually drop this coverage is if your premiums are not 0. But like I said, if you've paid in payroll tax for more than 10 years, that is going to be free. The next part is Part B. This is medical insurance. The premiums are very dependent on your income, which we will show a little bit more in the next slide. So this part covers doctor visits, outpatient care, home health care, preventive services, medical equipment, kind of everything outside of hospital care. You will need to register for this during your initial enrollment period, and this period begins 3 months before the month you turn 65. If you did start Social Security early, so before you turn 65, you may be enrolled automatically. Otherwise, you'll have to go in and sign up manually for Part A and B. The only way that this part can be delayed, excuse me, is if you are covered through an employer group health plan, but you would need to check with your HR department to see if that is an option for you. There are also special enrollment periods for Part B, and those usually are due to some kind of qualifying life event. So let's say you were under employer coverage and then you lost that, or you move outside of your plan's coverage area and need to change plans. Those would all fall under that special enrollment period. Part C is called Medicare Advantage, and in its alternative to Parts A and B. And this can also include vision, hearing, and dental insurance. So this is a little confusing because it sounds like it's a replacement. It does not stack on top of your original Medicare. So the Parts A and B, you still have to sign up for those. But Part C, it's a private company that's approved by Medicare that manages your actual benefits. And then finally, Part D is prescription drug coverage. And for this, out-of-pocket costs are capped at $2,100 in 2026. So this was a very big change in 2025, where you used to have what was called a donut hole. So you would pay up to your deductible, then you would have to pay everything, and then your out-of-pocket copay would kind of kick in. This got rid of that, got rid of the donut hole, and now that benefit or the out-of-pocket costs are just capped at $2,100 for everyone. Again, this will probably change a little bit in 2027, but that's the 2026 amount. Part C and D are run by private companies, but all these private companies are going to be approved by the federal government. The only thing that we did not mention on here is called Medigap. So this is extra private insurance, a Medicare supplement that will help you with your out-of-pocket costs. So that's something that some people use to kind of help manage some of those extra costs. All right, so if we can go on the next slide, we will talk about IRMA. So IRMA is an acronym that stands for Income Related Monthly Adjustment Amount. So that's why we call it IRMA. It's a little easier to talk about. So this is an amount that you get a surcharge if your income is a certain amount. And this is a little delayed. So the premiums that you pay in 2026 for Medicare are based on your 2024 income. So there is a little bit of a look back that would change what your premiums are a little bit going forward. So for the calculation for this, you first have to look at your adjusted gross income, which is on the first page of your tax return, and then certain deductions are added back in. If the most important ones are tax-exempt interest income, non-taxable Social Security. If you got a deduction for IRA contributions, you have to add that back in. If you deducted some student loan interest, you have to add that back in. You get to your modified adjusted gross income. And once you look at that, you look at the table that we have on here. If your income is between 0 and 109,000 for single filers or 0 to 218,000 for married filing jointly, your premium cost will be for Part B is going to be $202.90. Your Part D premium is going to be according to your plan. That's a little bit more plan specific for the prescription drug costs. But you can see as your income starts increasing, your Part B premium increases and your Part D surcharge increases quite a bit as well. So if you are making $500,000 plus, or as a single filer is $750,000, plus as married filing jointly, you aren't paying $202.90 per person. You're paying $689.90 per person. Your Part D coverage is going to be whatever the base premium is and then adding 91. So you can see that it adds up pretty quickly. This surcharge can be appealed if you experience a life-changing event. So let's say you retired in 2024 and now it's 2026 and you're starting Medicare, your premiums are going to be based on your 2024 income. If you were still working that year, the calculation is going to be based on a much higher income than what you're making now. You can submit a couple forms and some proof to Social Security, and it will the appeal will go through, and you will be able to pay the premium that is more in line with what you're actually making. But this is not something that's automatic. You do have to go through the appeal process. All right, and my next question is going to be, I want to save money for my children. What are my options? And then we put children. This does not have to be just for your children. It can be for grandchildren or other family members that you want to assist. So the first item we have for general investing is a custodial account. So we have the UGMAs and UTMAs. So UGMAs are under the Uniform Gift to Minors Act, and UTMAs are under the Uniform Transfers to Minors Act. They're the two kinds are very similar. There's a little bit of a different limitation to what assets you can put in each. For the UGMAs, you are limited only to financial assets, and the UTMAs can also hold physical property. But for most purposes, those look very, very similar. This is an irrevocable gift. The beneficiary, this minor child, is the only person that can use or benefit from the account. A lot of people will use this for education costs, living costs, things like that. The income is always taxed to the child, so depending on the size of the account, that can be a significant impact to the child. The other things to note is that the beneficiary of this cannot change. So once you name the child as the beneficiary, you can't change that. The child will assume full control at the age of majority. This is very dependent on the state. It's usually 18 or 21. In Wisconsin, it's 21, for example. Contributions aren't tax deductible, and this also has a very high impact on financial aid eligibility. So if you are applying for federal financial aid through the FAFSA, this is counted as a student's asset versus the parent's asset, which we'll talk about a little bit more with 529 plans. And so many people are very concerned with the rising cost of a college education. The cost is rising very quickly, a lot higher than some other costs. It's impossible to predict the future, so you don't know necessarily if your child is going to continue on to college or how much college is going to cost. One very good option for college cost is a 529 plan, which is on the next slide. So the benefits of this is you are able to put money into a 529 plan for your child, your grandchild, your niece or nephew, whoever you want to open the account for. You usually, depending on your state, can get a small tax deduction. There is no federal tax deduction for funding a 529 plan, only in your state. But any money that gets put in, once you take the money out, if you use it for qualified educational expenses, you can take the money out tax-free. You can use that for college, and you can also use that for K-12 private school. There are some other options that you can do with this. You can also use it to pay for some student loans, but for the most part, using it for qualified education expenses directly to the college are what most people use them for. A big option that has recently come about is unused 529 plans are now able to be rolled over to a Roth IRA. So this is dependent on two things. One, the child that wants to do the rollover to a Roth IRA has to have earned income. So the same kind of limits for regular Roth contributions, you can do a total of 35,000, but you can only do whatever the Roth contribution limit is for the year. So it's going to take you a few years to get that entire $35,000 out. And the account also has to be open for more than 15 years. So a little bit of limits with that, but it's a great option for people who end up with unused monies in their 529 plans. The nice thing about this type of plans is that it accepts third-party contributions. So parents are the most likely to contribute, but grandparents, aunts, uncles, friends, basically anyone can contribute to the account on the child's behalf, and the person that contributes is the one that gets the state tax deduction. But that is definitely something to look more into. Talk to your accountant if you want to utilize the tax benefits for that. The good thing about 529 plans is that this is considered a parental asset on the federal application for federal student aid, which is a little bit better than if it's owned by the student. And if it's owned by a grandparent or anyone else, it does not have an impact on the student's free application for federal student aid for starting in 2025, which was a big change and very welcome by a lot of people. Finally, we'll talk about a Roth IRA. This is if a child has earned income. So if they're working at a part-time job, if you own a business, they're working at your business. This is also something that the child will assume full control of at the age of majority, age 18 or 21. These are funds that are intended for the child to use in retirement after attaining age 59 and a half. So this is a great opportunity for children to get started on saving for retirement at a very young age. This is controlled by a custodian until the child is old enough to reach the age of majority and they can control it themselves. Just like in a regular Roth IRA, basis can always be taken out. So by basis, we mean what you put in. If you put $7,000 into a Roth account, the account grows to $10,000, you can always take out that $7,000 that you originally put in. Any earnings can be taken out of a Roth without any penalty or any income tax if, one, you have attained at least age 59 and a half, and two, you have had the account open for at least 5+ years. Now, 59 and a half is the very earliest you can take money out. If you are using this for retirement, we would absolutely recommend that you wait until you are actually retired before you take anything out. Again, for Roths, the contributions are not tax deductible. You cannot change the owner, and there is no impact on financial age eligibility. I will pass on to Brett to answer our remaining questions.
All right, thanks, Jennifer. As she said, I'll kind of bring us home here. It's good to see everybody, recognize a lot of names online, so appreciate it. But first thing I'm going to cover is how do I choose the right investments? A very loaded question. Obviously, it would be great if we could all just select the best individual stocks every year and sell the worst ones and continue that outperformance every year. The reality is, if we could do that, we wouldn't be here, right? We would be spending our time not working or having to worry about this. But the biggest thing when determining kind of how to choose the right investments is having an appropriate asset allocation. So that is the process of combining stocks, bonds, and cash to meet your investment objectives, goals, etc. This changes over time. It changes per account that you have and the certain goals tied to that account. But again, the three kind of main questions you really have to ask yourself on the next slide here is what's your risk tolerance? What are your goals for this account? And what's the time horizon tied to that account or to that goal? So, what are your goals for this account? Isn't it an emergency fund, which is 3 to 6 to maybe 12 months of cash saved up of fixed living expenses for anything that comes up unexpectedly? Or in retirement to just have that flexibility with an increased cash bucket that allows you to be a little bit more strategic in distribution strategies. Any upcoming planned expense, maybe it's a house remodel, maybe it's saving for down payment on a house or down payment for a car, et cetera, and then retirement, right? So these are really three separate goals that have different investment strategies applied to them. And then how soon do you need the money that you plan to be invested? Anything 0 to 12 months should really just be invested in liquid cash, because we're less confident in where we think markets are going to be 12 months from now than we are 5 years from now, 7 years from now, 10 years from now, right? So again, anything from 0 to 12 months, you want that to be invested in liquid cash. Anything 1 to 5, you can take on some risk with that, right? It can be invested in some type of risk asset classes, maybe not 100% invested in the stock market, but some blend between equities and fixed income and cash. And then 10 plus years, that's really an investment cycle and then some. So that time horizon, you can be more comfortable with taking risk, taking equity market exposure to give your money the best opportunity to grow over that period of time. The next chart, really, it's a good, and you've probably seen this in education for anybody that has sat in on those sessions. It kind of covers the trade-off between investing and risk tolerance and really how that changes over time. So this is really just like one visual at a point in time. Obviously, everybody's situation is different. The goals around different accounts that they're investing in is different, but this is kind of a good visual that shows how your asset allocation, your mix between stocks and bonds and cash should change over time. So obviously, when you're very young, you have this long time horizon until you retire. So you really want to be invested aggressively or invested in the stock market, areas of financial markets that are going to give you the greatest expected return. One of the things that I see is that people are participants, especially in 401ks, they might be invested too conservatively based on their age. Now, risk tolerance is obviously the most important thing. But if you're, 30 to 40 years old and you're invested 50 to 70% in the fixed income market, I think that should maybe be, you should take a look at that, right? Because you still have this long time horizon. You really want to take on a little bit of risk with those monies to give you the most expected return. So you can see the green dotted line is kind of the target retirement dates. You can see your stock market exposure going down, fixed income exposure going up. Obviously, the $1 million question is like, when do I make this change? It's easy for me to just say, yeah, like you should just follow this flow. When in reality, if you are 90% invested in the stock market and you kind of want to get to 70% and you have $1 million, well, that can be stressful on when to make that change. And it's never going to be perfect. So it's good to kind of set those expectations when you do make that transition. But one of a bigger mistake that we would see is, let's say you are 90% invested in the stock market and you want to go to 70%. You don't want to do that when markets are down 15% or 20%, right? Because you're locking in those losses and you're taking away from the future growth of that account and the timeliness of when it can get kind of back up. The time you really want to do it, make that conservative change, is when markets are at a high. And sometimes that's not intuitive in our brains because when things are working, we just want to keep doing it. But again, the older we get, the less important returns become. And what's most important is, what investment objective is appropriate for you to accomplish your goals. And the last thing I'll say about this visual is that you do want to have some cash in retirement. It really allows for you to have distribution options. For example, let's say markets are down 20% and you're pulling from your retirement accounts, right? Because you're retired and you're paying yourself back. Maybe you want to deplete or decrease the enhanced cash level that you have, allow your investments to kind of rebound, maybe not all the way back, but not take from it when it's 20% lower or 15% lower. That's just kind of a small example of the flexibility that having an increased cash level can provide. And then the last thing I'll say about kind of asset allocation is diversification. I know most people have probably heard this, but rather than trying to pick the potential winners and avoid the potential losers, diversification really has you invested spread across the entire market. This really does increase the long-term success of portfolio returns, and it also decreases potential volatility, right? So The great thing about being invested in one stock or one area of the market is that when times are good, times are very good, right? And it's gonna make you feel really good about your investments and the performance of them. The trade-off is when that area of the market or those individual stocks are pulling back or in a sell-off or in some type of contraction, that is not going to make you feel any good, feel very good, and that's when emotional decisions can start to show their face, and mistakes can be made that can impact the long-term success of your portfolios. So diversification is very important. You're never going to hit home runs by being diversified. That's not really the point of it. The point is to smooth out the returns, the volatility. And we know historically diversification and having a proper asset allocation, it works, right? You're going to win from those strategies over longer periods of time. One common misconception that we kind of get is you don't need to diversify your assets across multiple institutions. Or we have some people that say, and there's nothing wrong with this, I like having my assets across different advisors because it's diversified. It's not wrong to have your assets divided across other advisors, but it doesn't necessarily mean that your assets are any more diversified if compared to just having it all under one umbrella and making sure that proper asset allocation is applied to that portfolio. So again, just because your assets are at different institutions or with different advisors does not mean that it increases diversification to your portfolios. And then next question here, what is a fiduciary? So I will say the industry in general has changed over the years. A lot of advisors or investment management firms are evolving into this fiduciary landscape. I can tell that there's a lot of articles revolved around being a fiduciary because we get it, at least I get the question a lot more from participants or prospects, are you a fiduciary? Which is a great question to ask when you're working with an advisor or when you're kind of shopping around for advisory services. But TrustPoint Emerge 360 is a fiduciary, and we'll kind of cover what that means here in the next couple slides. But the definition of what it means to be a fiduciary is a individual or an organization that acts on behalf of others and are required to put the client's interests ahead of their own. So that's kind of the big one. Number two, act with prudence and professionalism. Got to act with good judgment, diligence, and care. Loyalty to the customer is key. To the client. Don't mislead clients. Be very transparent around what they're being invested in. What that means to their financial picture. Avoid conflicts of interest. We'll go into a little bit more about this in depth on the next page, but fiduciaries must create a trusting environment in order to best collaborate with their clients. And the only way to do that is to disclose any conflicts of interest that could hurt the client or hurt the client or the work they do together. And then fifth and final is fully disclose and fairly manage. As fiduciaries, it's our job to remove any obstacles that would impact our judgment or objectivity. So the next slide here, I think, is very important to understand when you are, meeting with your advisor or when you're shopping around for advisors is how does your advisor get paid? What's the compensation model tied to the services that they are providing? So TrustPoint and Emerge 360 and all other fiduciaries are fee only, meaning the client pays a fee to the advisor, and in return, the advisor provides services to the client: investment management, financial planning, tax planning, estate planning, etc. There are no commissions or incentives, so the advisors should mostly be hourly or salaried. There's no conflicts of interest, meaning that they don't need to invest in a certain product or a certain mutual fund company that kicks back a commission. And this is upholding that advisor to the fiduciary standard. Another compensation method, and this is more what it means to not be a fiduciary, the client still might pay a fee to the advisor and get various forms of advice, but then there might be certain commissions tied to that relationship through the form of annuities, insurance contracts, mutual funds, etc. We are not here to say that one is right or wrong or one is better than the other. It's just that sometimes one compensation method is fully transparent, and that's the fiduciary fee only compensation method, where we can see some non-transparent structures that revolve around different commissions or kickbacks being applied to advisors for the services that they are providing. So again, not to say that one is right or wrong. One is definitely more transparent to the client and the services that they're expecting. And then questions to ask an investment advisor. So I alluded to a lot of these in the last couple slides, but are you a fiduciary? How are you compensated? Do you sell any products? Will I be paying any commissions or transaction costs? And will you actively be managing my portfolio? These are all fair questions. I don't want, you shouldn't feel timid about asking these questions just because you've maybe never asked them before, don't know how to ask them. But I think it's very important. TrustPoint thinks it's very important that the client completely understands the services that they're being provided and the cost of those services, that the investment management fee that is being charged to manage their money to provide the services that they are looking for. And then the last question here is, what are the biggest mistakes that prevent people from building wealth? I'm not going to cover kind of all of these, but the top one is kind of obvious, just spending more than you earn, right? What is going out is more than what's coming in over longer periods of time. The math doesn't math, right? It's just not going to work out for your financial plan over longer periods of time. Making emotional investment decisions. We see this quite a bit, especially on the 401k participant side, where markets are down 15, 20% and participants instantly want to go to cash, which might be the worst possible thing for them to do at that time. Having too much cash or not enough cash. So again, having that emergency fund is very important. The last thing you want to get into is a situation where these unexpected costs come up and you don't have the cash to afford it, and you have to borrow money at maybe a substantially higher interest rate than what you typically thought you could. Having too much cash can also be an issue because it might not be working in your best interest. Now, again, that's kind of a loaded statement because it all depends on what goals you have, short, intermediate term cash needs, et cetera. Underestimating longevity and future healthcare expenses. This is a big one. We are living longer, which is no secret. When we're doing financial planning for folks, we have folks living out to 94 and 92. So again, we are living longer, which is great. It just means that we need more as far as resources go, and we don't want to underestimate living too long. Losing track of old retirement accounts. So this is a very specific example, but if you leave an employer and your account is under $7,000, it's going to be rolled more than likely to what's called a restricted IRA account, which is only going to be invested in the money market account. All right. So like, let's say you have different careers, you have like 4 or 5 different retirement accounts, and they all have small balances. Well, in isolation, in singularity, they're not that much, but you combine them all, maybe it's $20,000, $30,000, $40,000, but it's all invested in cash and you forget about it for 10, 20, 30 years, right? That's a real money that could be working for you in a better capacity. So, don't lose track of old retirement accounts. I think it makes sense to consolidate them as you go, whether it's to a 401k plan or with an advisor, consistently rolling to an IRA as you leave employers. And then not working with a trusted financial professional when things get more complex. We're going to cover in a couple slides kind of like what it means to work with an advisor and the value add of that. I would say in summary, just working with someone to help keep you in check and to provide a roadmap can be very important along the way. So the next slide kind of breaks that out. Value add of financial advisors. This was a study done by Fidelity. So industry studies estimate that professional advice can add between 1.5 and 4% to portfolio returns over the long term, depending on time period and how returns are calculated. That might seem far-fetched, but from experience and what we've seen here at TrustPoint, I believe this to be true. We will have prospects or clients that might have been invested way too conservatively or had way too much cash on their hand. cash in their accounts and it wasn't working in their best interest. So, missing out on like 1 or 2 years of returns, whether it's 5% or 15%, can really be impactful over longer periods of time. And then percentage of investors who say they feel confident about reaching their goal. So this should be of no surprise. Be like, I feel more confident asking my doctor if there's a health issue that has arisen in my family, right? So one of the biggest things that I want to maybe point out is minimizing taxes. So part of financial planning is tax planning and distribution strategies, and that can really be powerful over longer periods of time. We don't know where tax rates are going to be, right? It's all kind of a guessing game. But there are certain times of your life, depending on how old you are, what your tax situation is, how much you're making, where it makes sense to contribute to certain buckets at one time, maybe certain buckets in, later on in life, right? And all of that has to, revolve around, the tax planning and hopefully minimize paying some taxes over longer periods of time. And the next slide, what is financial planning? So financial planning is really it's the hub that brings everything together when you think about your financial picture. At TrustPoint, it's really the core of what we do. We do investment management, meaning we actively manage client portfolios, and all of that is done in-house. But financial planning is a very important piece of what we're doing, and it's really what this industry has evolved into over time. People want the tax planning, the retirement planning, the investment advice, the estate planning, right? And they want a place they can go to where they can get advice or planning around all of those topics. So at TrustPoint, we built out a financial planning team. I think we're up to 7 or 8 certified financial planners or CFPs. But think of it like a quarterback on a football team. The financial planning concept is really taking all of these things into consideration in making sure that when things change for you along the way, whether it's goals, income, age, whatever happens or whatever changes, the financial plan is being, updated, and is working for you and is fluid throughout your career and into retirement. So how can Emerge 360 or TrustPoint help? So Paige mentioned it at the front end, but we are an investment management firm. We're a fiduciary. We do charge an investment management fee based on the assets that we're managing, and we do have an investment relationship minimum of 50,000. So what this includes is the active investment advice, the ongoing financial planning, a dedicated team of fiduciaries, certified financial professionals, et cetera. And we're a holistic financial planner investment advisor. So if you have outside 401ks or IRAs, or your spouse has outside accounts that maybe you don't know how they're invested, or you're not sure the advice that those accounts are getting or the active management, those are all examples of accounts that TrustPoint can help administer. If you receive an inheritance, or you built up, you sold a house and downsized, or you just have built up cash savings, we can administer all different types of accounts. Even more kind of specific, kind of going away from IRAs or just like joint or individual brokerage accounts. We can do self-employed accounts if you or a spouse are self-employed, solo 401ks. There's a lot of different accounts that TrustPoint can administer, again, under the TrustPoint and Emerge 360 umbrella. And then Paige also mentioned it at the beginning. We do have an in-person retirement readiness seminar coming up. It is October 13th of this year. It'll be at the Boys and Girls Club of Greater La Crosse Workforce Readiness Center, which is on the north side of La Crosse. Appetizers and drinks will be served. It'll be myself, Paige, and a member of our certified financial planning team. So feel free to scan the code. You'll see if you're signed up for our marketing material, you'll see the invites come out at that time as well. So that is all we have. We kept it right at 45 minutes, which was the goal. So thanks for joining us. As a reminder, we'll be sending out a recording of today's session. If you have any questions, please reach out to either of us. Call in, ask for one of us, or you can reach out to the general email or phone number below. Don't forget to check out the website, for upcoming events, especially, the retirement readiness one, which is in person. But in the meantime, if you want more information or insights, please feel free to visit our social media pages too on Facebook, YouTube, LinkedIn, and different articles on Emerge 360 or trustpointinc.com. Our website is updated with new information at least weekly. So, we really welcome the chance to help those that you care about. So as Paige said, if don't keep us a secret. If you know of someone that has any questions regarding their retirement, estate, or just investment questions in general, please have them reach out to us and we would love to help. So thank you again for joining. Hope to see you guys down the road and have a great rest of your day and week. See ya.